Hey, welcome back to Fetta Facts. Jerry Fetta here, CEO of Philanthro Investors. And I want to give you a very in-depth Fetta Facts today about private equity, angel investing, venture capital investing. What are those? What are the differences? Stay tuned. We'll find out today. Hey, welcome back to another episode of Fetta Facts. Jerry Fetta here, CEO of Philanthro Investors. So I want to go over today, because Fetta Facts, again, it's all facts, no opinions, right? And I want to go over some of the definitions, some of the key terms that are used in the venture capital space, the private equity space, the private investing space for high net worth individuals, right? Now, one of the key terms that I want to go over again is I want to cover the definition of an accredited investor. Okay, an accredited investor, because a lot of these specific types of investing in the private investing world require you to become an accredited investor. So an accredited investor for an individual, it means you either have a $1 million net worth. Okay, net worth means what you own minus what you owe is greater than $1 million. You don't count the house on either side. You don't count the equity or the mortgage, right? So you have $1 million net worth. You can also be accredited by income. So you have $200,000 per year, 2 years in a row, if you're single, right? If you're married, household income needs to be $300,000 a year for 2 years in a row, right? So for me personally, I've been accredited for many years. Now, as an accredited investor, you have the ability to invest in private investments, and I call them private investments because there's different classifications in that group, okay? As opposed to what? Public investments. A public investment, you can buy a share of Apple stock. Anyone can do that. That's on the public market, right? You're buying it from a public person. Someone else owns it. They're trading it to you. It's a public transaction. It's listed on the exchange. That's why it's public. Private means it's not listed on the exchange. It's not a public transaction. You're typically buying it from, a fund or an issuer, or you're buying into the company itself, right? And so it's really important to understand a couple of the key groups here. Now, these are terms that when I first heard them, back when I was learning about these things, they were things that I thought meant all the same. I was like, okay, that's all same, like different words for the same subject. And it turns out they're very different, right? So one of the key terms here is the actual term private equity. We then have venture capital. We then have angel investing, right? And again, these are all different terms. Okay, we have private equity, venture capital, angel investing. These are the three main ones you're going to hear about. And I want to talk to you about the differences. Okay, so angel investing in an idea. That's really what that is. You're investing in an idea. So with angel investing, typically the company is in the startup stage. It's pre-revenue, meaning they've not made any money. They've not made any sales yet, right? And so this is where you're an angel investor, and you'll see companies like, Uber and some of these different ones had angel investors backing them because the founder had the idea, but the idea didn't make any money yet. See what I mean? Now, this is different than the normal type of investing you may have heard me talk about, investing for passive income. You're investing in things that can't lose. That's where you start. Right? You start with the passive income investments, the things that can't lose, the real hard assets. That way you've got a good foundational layer in your portfolio of investing. You become financially independent that way. Hey, what's up? Jerry here. I just wanted to give you another reminder. Grab my book, Blueprint to Financial Freedom. It's going to be one of the best books you have ever read on finance. I can promise you that. You're going to love it. It's also a free offer. So if you go to jerryfetta.com/B2F promo, you can get that now. Meaning you build passive income and you stack up, the income that way, and you basically buy your time back. You get into private investing, you've graduated, you're financially independent, right? You've got, a $1 million net worth or higher. You have surplus wealth. You can now invest in angel investing, right? So if you're doing angel investing, again, it's investing in an idea. It's pre-revenue, right? And it's very high risk, very high reward. For every Facebook, for every Uber, for every really brilliant idea that was funded and known about, there's a lot that don't do well. They don't make it. And so when you're doing venture capital, you don't want to go all in on something like this. You do want to look at, does this make sense to me? Do I want to support? And I don't even want to use the word speculate. Speculate means, I've got no attachment to what they're doing. I'm going to buy it at this price. I'm going to try and sell it at that price. Angel investing means you believe in the idea. And so I want you to realize as an angel investor, you're supporting a founder. You're supporting a mission. You're supporting a purpose. You're saying, I believe in this and I'm willing to put capital behind it to try and help it. So I want you to think about a seed that's been planted and it needs water and it needs sunlight and it needs nurturing. And one day it could become this giant tree with all of these great, fruits and squirrels, whatever else is on the trees, right? Beside the point. But you're going to help get it there. As an angel investor, you're going to help get it there, right? So that's angel investing. Now, the next one up is venture capital. Okay, venture capital. So these are still like early. You're not investing in just an idea now. You're investing in an idea and typically a group. This is pre-profitability, right? So venture capital, usually they have sales. They've got revenue. They might not be profitable yet. And so you're coming in as a venture capitalist investor and you're saying, hey, I'm gonna support this company. I can see, and this is the kind of stuff you might see on Shark Tank where, they're forming the company. They're not profitable yet. They do have sales. They are operating. They do have a team of some sort, and it's not just an idea. There's a little bit more there, right? So you're getting into the venture capital world in that stance of investing. Okay, and that's a little bit different. You have companies that have already got some track record. They're not usually winning yet, and that's why they're raising money from investors, is they still do need that support, but it's not a seed. It's kind of grown into a shrub, and you're like, okay, good. This is not just a seed. It's turning into a little tree, a little bush. It does need more help. It does need more watering. It does need more support, and so I'm going to buy into it at that level. Okay, when we get into actual private equity typically are profitable and somewhat established, right? You're not in the idea zone anymore. You're not in the formation anymore. The company is formed, it's profitable, and maybe they're trying to scale. Maybe they're trying to go from one location to 100 locations, right? But they have proof of concept, they have revenue, they have profit, they've got a team, they've got infrastructure. And so if they're raising money, private equity, that's more what that's going to look like. Okay, but it's important to understand these three different terms because it's three different ways of investing in the private world. Okay, it's three different ways of I'm going to get into, angel investing with an idea. I'm going to get into venture capital with a group that makes money, but they're not profitable yet. They need to expand. They need support. Or I'm going to get in with a company that is profitable and they're looking to do more and they want to raise money to accomplish that. And all of those are private opportunities versus the public opportunity. The public opportunity is Apple, right? Now, I want to point out, why do companies go public? Companies go public to either raise money for expansion on a very big scale and or to cash out the profits of the original investors. Okay, so somebody that buys into a angel investment, somebody that buys into venture capital, someone that buys into private equity as an investor, you're getting in before it's public. So if a company then does go public, right, you have the opportunity typically to get cashed out at a very high rate if the stock does well when it goes public. Next, I don't want to interrupt you too long. I just want to give you a free offer for my book, The Blueprint to Financial Freedom. If you go to jerryfetta.com/B2F promo, you can get the book now. I'm going to let you get back to the video. Okay, now I'm not about Wall Street. I'm not interested in public stocks because I feel like that's just a casino. But there's something to be said for the companies that before they go public, the investors and the owners that are already in, making a lot of money on the back end because of the company going public. A private company might not go public. They might stay private. So then you've got, private stock that you own that has value. It appreciates. It might pay you income, right? But you want to think about, what are you looking to accomplish? So as the CEO of Philanthro Investors, I know companies that are about to go public. Huge opportunities there. Okay, very good thing if it goes public and does well. I also know companies that they don't really plan to go public. They're going to stay private, but they want to expand. Both different, right? So I hope that this gave you some insight on this private investing world. Now notice, nowhere did I say real estate fund. Nowhere did I say private lending fund. This is the deal with that. Real estate is not new. You don't need a business or a fund to buy real estate. If you want to buy real estate, you can just go buy real estate. The reason someone starts a real estate business or a fund typically is, number one, they don't have the money themselves. right? So when I'm looking at like private equity, I'm like, okay, I could take money and put it into a private investment. Do I want to go into Uber before it became Uber, Facebook before it became Facebook, and Amazon before it became Amazon? Or do I want to go into a real estate fund that's going to pay me a 4% preferred return and I might make some money when they do cash outs and refinances? Okay, if I'm going to do one or the other, if I'm in real estate, I don't want to do it as a fund. I would rather own the properties. I like doing seller finance. I get much higher cash flow on that, right? So that's the direction I'm leaning. And if I'm going private, like I'm going private for a reason. I'm going to go into venture capital or angel or private equity, and I'm going to try and really use that world for what it's intended to be, which is not buying an apartment building. You see the difference there, right? So, and I'm not saying that that's a bad way to invest. I'm saying that's my mindset. If I'm doing the real estate, I don't need the funds and the managers and all of this extra expense. It dwindles my returns down. I can get into real estate much easier with a higher yield. If I'm doing private equity, I want to really do private equity. If I'm doing venture capital, same thing. If I'm doing angel, same thing. But it's very important to understand these terms, the differences, and also when you would get involved. Timing is such an important key. If you're broke and it's your last $10,000, probably don't go do angel investing. Okay, probably don't even go do real estate investing. Okay, if you've got, some money in a retirement account and it's $200,000 or $300,000 and that's your life savings and your nest egg, I probably wouldn't put all of that in private equity. I would probably be looking at things that meet, again, my definition of investing, which is clothe your capital. That's the origin of that word, right? Those points, right? I like it. I understand it. It fits me. It fits my goals and purposes, the things I'm going to use it for. It's a life essential. It's vital. It's fairly priced and I've got control over it. Those are the things you've got to check off first and foremost. Then when you have surplus, then you can say, okay, good. I'm going to do the angel. I'm going to do the private equity. I'm going to do this or that because it's high upside, but it's also higher downside, right? And you've got to be able to live with that possibility as an investor. So I hope this was beneficial. I hope this gave you some more just education and facts on some of the different terms used in this world. The reason I wanted to introduce those is because I'm going to be doing more content on this, right? And I want everyone tracking with, okay, what are we talking about? What type of investment is this? What classification does this fall under? That's it for today though, guys. Thanks for watching. Like, share, subscribe. If you have any questions or comments, throw those down below and I'll see you next time. Hey, this is Jerry Fetta here. I want to thank you for watching my video, watching my content. I hope you enjoyed it. If you would like to learn more about the blueprint to financial freedom and how you can achieve passive income that exceeds your savings, your expenses, your taxes, your generosity, and build wealth like the top 1%, I want to encourage you, grab a copy of my book, The Blueprint to Financial Freedom. You can go to jerryfetta.com/B2F promo, or you can click the link in the description of the video here. The copy is free. You cover your shipping. We'll send the book out to you. And we'll send you an email with a bunch of great bonus material also for free. Get the book, subscribe to the channel. I'll see you on my next content.